Hello, and also, hello. I know you normally expect a bombastic beginning to these videos, but I don't want to undercut the main point. That FOMC simultaneously sucked and blowed. In an astounding move literally no one saw coming, that crazy old man Jay Powell decided to hold rates steady.
Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings.
And because I don't have enough time in my mornings to create a lengthier intro, here's the most satisfying moment in TV history.
Oh, I can't stand the wailing of women.
Welcome everybody to the Daily Recap Show, where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. It really helps me out. Let's get into it. This is the daily heat map of the S&P 500. And yes, this is the daily heat map. I know you see Nvidia up 13% in a single day. That's a $3 trillion company, guys, trading like a small cap biotech with 2 drugs in the pipeline. AVGO up 12.25%, and it all stemmed from AMD's raise yesterday. They pretty much raised guidance. I mean, earnings were average, but they raised their guidance and Nvidia benefits. That's how you know it's Nvidia's bull market. We saw continued upbeat action here in financial services on the back of PayPal, as well as MasterCard releasing their earnings today. Very good earnings. And I think we're going to see follow through in the tech trade because Meta dropped their earnings. Very good earnings. A double beat on both sides. Smashed the EPS estimates. We're going to talk about it a little later on in the video, but it really was all tech today. Technology up 4.2%. And this is on the back of Microsoft being down 1.13% today. Tech was up 4.2%. The second biggest or third biggest stock in that index was down a percentage point, and the entire sector was up 4.2%. That just goes to show the strength in the rest of the sector as well as Nvidia. Discretionary gained as well. Utilities up 1.3%. Very weird to see that. And then communication services up 1.2%. These sectors right here, com services, discretionary, excluding utilities and communication services, it's just the Mag 7. It's just software and technology names in those sectors. I mean, the discretionary space is mostly just Amazon and Tesla. They make up like 50% of that sector. But it wasn't just technology. Industrials were up 1%, materials as well. Energy, despite the movement in oil, only gained 0.4% today. I mean, crude oil at one point was up nearly 4%, and that's what we saw with energy. So very weird divergence between the two. And then the worst performing sectors here was financials, staples, real estate, and healthcare. Very rate sensitive, defensive, and cyclical sectors. But with regards to financials, they probably fell because they were the best performing sector yesterday. They were up 1.5% yesterday, and all they're doing today is just giving some back. That tends to happen in the stock market, but we saw a rally in all shapes and sizes. Smalls were up, mids were up, larges were up, but the biggest beneficiaries was just large growth, up 2.7% for the day. And today's price action was predicated on a number of things. The first was that we saw a huge move in yields, especially longer duration yields. This right here is the 10-year yield, and it took a steep move down today, falling 2.61% after Jerome Powell's comments. We're going to talk about the FOMC and what he said, but there was definitely a change in vocabulary and signaled some stuff to the market that almost guarantees at least one rate cut by the end of 2024. At the same time, when we look at stuff like the Nasdaq 100, what we're also seeing is just a bit of a rebound off these lows, and generally the move tends to be quite violent, and that's why we saw the Nasdaq 100 up 3% today, and by extension the S&P 500 is going to gain up 1.58% today. Smaller space of the spectrum, the IWM, the RSP, mid caps, and the SP 600 all came off their highs in a very significant way. They were very upbeat early on in the market. Then we saw the smaller size get sold off in favor of the larger size. However, they were all positive about 0.5% today. And the big thing that also helped large caps along with yields falling is that the dollar actually fell as well. It was down 0.4%. That really helps the large cap space in particular. And then we did see gold up 1.52%, looking like it wants another all-time high. Silver up 2.1%, back above the $28 region. And then crude up 4.26%, but energy stocks simply didn't benefit from that move, but they maybe will tomorrow. However, there was interesting developments in the IWM. Look at this. We actually made a wick 52-week high. If we go to a 1-year chart, that's a 52-week high for the IWM at the 228 level, but it wasn't a closing high. Nonetheless, we did have price discovery at this area right here. And that was actually the same for something like the RSP, wick, all-time highs, by the way. Mid caps, that was a wick all-time high, and then SP600, same thing, 52-week wick high. So the smaller end of the spectrum still making key levels, but not quite as strong as something like the S&P 500. And we really need to talk about this because we are pretty much at the gamma flip zone here at the 55.25 level. We were in negative gamma right here. At this point right here, I thought we were going to go back to the 5300 area. However, the put support did actually move up to 5400 today. So this was the area where it bounced, and now we're at the gamma flip zone. So here at 55.25, we actually were in positive gamma for a little bit here today. We did wick above, but we closed at the 55.25 level. And I mean, let's say tomorrow we have some upbeat action overnight, like we're currently seeing the SPYs up 0.19% in extended hours, boosted by stuff like Meta and Paycom, which had great earnings. If we go ahead like gap up above this, we could literally see dip buying, rip selling all the way to potentially like the 5600 tomorrow, maybe the 5590 area. That's definitely on the bingo cards if we do gap up and then we're in positive gamma. However, if we continue to stay here, that really does open up lower levels. They put support, and that's how we play. In negative gamma, we look to the put support levels 53, 5400. In positive gamma, we're looking at the 5750, 5700 area. So it really depends what happens tomorrow. For the positive gamma price action to materialize, what you really want to see is a gap up and maybe a strong close, maybe even retaking some of these key levels. That's how you know it's on, and then we can maybe open up some of these all-time high levels and then the core resistance above. But if we sort of just have like a wick above here tomorrow, maybe a gap up, right, and then sell off, use that support and go down, that probably means we still are in a bit of a volatile period, and then we would still look to 53, 5400 as our initial areas of support. That is the S&P 500. For the Nasdaq, I literally said it in yesterday's video. Go ahead and watch yesterday's video. I said to you guys, clear as day, I said the place you want to buy is right here in the Nasdaq 100, because this was literally a 10% correction, peak to trough. You know, generally every 5% you want to load up a little, but every 10%, that's really where you want to like load up big on the stocks, the ETFs, and the indices that you really do like, because this is where markets tend to bounce, these psychological levels, 5, 10, 15, 20, and that's exactly what we're seeing right now. It didn't quite hit 10% on a peak to trough level. It was 9.87%, but inconsequential when you think about it. And right now for the Nasdaq 100, this is the low. If bears want this to continue lower, they need to go ahead and take this 18,800 level. And right now for the bulls, it's looking fairly constructive, especially after you've broken above this supply zone right there. For the bears, they need to push below, use it as support, and continue to move lower. For the bulls, it's very, very simple. Go ahead, close that gap. In the IWM, this is very constructive. I still want to see a close above that high right there. If we go ahead and do that, then we could see 230 and 245 in the IWM. It won't happen this week, but we are seeing healthy price consolidation in this area. And it still looks like if we do get to this 217 area, this is the place you want to buy, get long, and stay long. So we had another big day of earnings, and it's not even the biggest day of earnings this week. That will come tomorrow. Today, we did have some big names. We had one Magnificent Seven name. Meta reported earnings, a double beat. The market liked it. At one point, Meta was up close to 8%. ARM reported their earnings, as well as Lam Research. Both were down about 8% in the after hours or somewhere around there. So we're going to see how that's going to affect semiconductors. ARM is sort of in its own individual space, and Lam Research is actually an equipment manufacturer. So that's really going to signal to market the health of the overall market. Carvana was actually very green, up 8% in the context of also being up 5% in normal trading. The market liking what they're seeing, and this stock has been absolutely crazy. Wingstop was relatively flat for the day, which is kind of insane given the rally it's had. MasterCard, great earnings, by the way. Fantastic earnings, far better than Visa's earnings. Really good earnings, really great for the credit card space. Up 3.63% on the day, and it was a fantastic day of earnings, to be honest. There were a couple of mild outliers, but all in all, it was good. Tomorrow, we have the big boys, Amazon, Apple, Intel. We also have Coinbase, DraftKings, Roku, Block, Marathon, Bookings Holding. Very, very big day. Probably the biggest day of earnings tomorrow. And then on Friday, not as big as the past days, but we do have some notable names. So we look at earnings on this channel quite a lot, especially the S&P 500 earnings scorecard. And earnings is one of the three components, along with the macro and the technical, that we look at that really gauges where stocks will be 12 months from now. In the very long term, earnings is all that matters, and it's ultimately the longer term driver of growth. So we've had about half of S&P 500 companies report earnings, and we can see here that we are officially reporting 12.4% in blended earnings growth. Just yesterday, this number was 12%, and that's because we had companies like Microsoft, PayPal report stellar earnings. They are big contributors to S&P 500 earnings. We also saw revenue move up in a very big way from 4.5% at the start of this week to 4.9% above the analyst expectations as well. We also saw X Energy move up as well, and margins are staying at the 12.1%. But what's even more interesting is that very close to 80%, 79.4% of all companies that have reported are reporting above analyst expectations. The long-term average, by the way, is 66%. So earnings are looking good. So if anybody tells you this rally is predicated on nothing, they don't know what they're talking about. 12% growth at an index level is absolutely stellar. But what about the other indices? Now, this right here is blended earnings growth for S&P 400, S&P 600, and the Russell 2000. Now, what we're looking at is second quarter earnings growth right here. And we can see that growth for the mid caps is actually still reporting negative at the moment, negative 4.06%. For the S&P 600, it's a negative 11.82%. That's actually brutal earnings. And then for the Russell 2000, negative 12.53%. And you can see why the S&P 500 has actually outperformed all of these indices, because in the current quarter, the S&P 500 is simply reporting the best results. However, this is set to change for each and every single one of these indices. You can see that from the third quarter onwards, we are expecting to see positive earnings growth into the end of 2024. By the end of 2025, every single one of these indices is going to reporting high teens double-digit growth or above. 17.7% for the S&P 400, 19.3% for the S&P 600, and then 37% growth for the Russell 2000. And that is at an index level. That is just wild. Look at some of these quarters: 56% growth, 58% growth, 42% growth. Absolutely insane earnings. But we'll see if it materializes, because the Russell 2000 especially, and another reason why I've always championed small cap quality, if the Russell doesn't hit these earnings right here, the valuation in the Russell looks rather expensive, especially on 2025 earnings. In fact, and if we actually look at the S&P 500 and the Russell 2000 on 2025 earnings, the S&P 500 is actually cheaper, and you're getting a far higher quality basket of companies. Now, with inflation falling and earnings rising, we are actually in the sweet spot where moderate inflation and accelerating earnings tends to have the best annual returns, 14% on average when inflation is in the 2 to 3% range, and it beats both the 0 to 2% and 3 to 5% mark. And this is part of the reason why stocks are rallying. Disinflation is good for stocks. Disinflation plus accelerating earnings is even better. Let's talk about the FOMC. Now, there wasn't anything major that happened today. The goal of the Fed is not to surprise the market or to come out with something big. In fact, they kind of signal to the market what they might do, but they try to be as transparent as possible. Now, Jerome Powell generally kept his same stance. There was no explicit signal of a September rate cut, but there was some very meaningful changes to the top of the statement. Instead of saying inflation remains elevated, he says somewhat elevated. These are big changes to his wording that we have to pay attention to. Another thing is the dual mandate is back. It's no more just inflation. It's now employment and inflation. And I think the biggest thing that came from this meeting was a statement he made in the press event. He said there was a real discussion about the case for reducing rates at this meeting, but the strong majority supported not moving rates at this time. Literally, they are talking about cutting rates. This is your signal that they are going to cut at least one cut in 2024. We're looking at 25 basis points. That may come in September, November, December, but it's official, guys. Rate cuts are on the table. Literally, they're talking about it at their meetings. So that was the FOMC. Nothing crazy, but just a changing wording and the board expressing their views as to how they see the economy right now. Now, with rate cuts clearly in front of us, let's talk about what happens to assets when the Fed cuts rates. Fed cutting cycles can be very supportive for gold if followed by weaker growth Gold tends to rally when the Fed cuts rates and a recession follows, but we tend to see lackluster results up to the first 12 months if the Fed is cutting rates and growth remains stable. Regardless though, 24 months later, we tend to see quite substantial returns on average from gold after the Fed cuts rates. That's because you're debasing your currency. Gold is simply a hedge against that. And if you are worried about purchasing power, gold is definitely an asset you should look at. Commodity performance in general around Fed cutting cycles is particularly sensitive to growth. Now, gold tends to perform well regardless, but commodities, when not followed by a recession, tends to outperform. But if a recession occurs, we see commodities slump, and even 18 months later, we can actually see a negative alpha before rebounding to an equal plane here 24 months later. So it's really best to time commodities or just stay in gold and silver as your commodity. However, on average, you could see that commodities tend to perform well after a cutting cycle, but I think you got to take this with a grain of salt and really pay attention to the macro. And then looking at equities, equities tend to perform very well after a Fed cutting cycle unless growth is weak. Very similar to gold, when the Fed cuts rates and there's no recession, so essentially just to normalize policy, we see equities go on a blockbuster rally. This is the average if no recession. 24 months later, after the first cut right here, we can see S&P 500 returns are very close to 40% on average. However, if followed by a recession, 24 months later, equities tend to be flat and tend to be in quite the drawdown for a significant portion of those 24 months. So if equities are particularly sensitive to growth, and if growth is weak, we could see drawdowns. We need to actually have a look at the growth outlook. Growth is expected to remain robust across an entire range of economies. Looking at the United States, Goldman Sachs actually predict 2.6% at the end of 2024. The consensus is 2.3%. I always say the truth is probably somewhere in the middle. For 2025, Goldman expect 2.3%. The consensus expect 1.8%. Japan has the weakest growth amongst all of these economies, negative 0.1% here in 2024, but that is set to pick up in 2025. The euro area is seeing modest growth in 2024. We see China, very robust growth, 4.9%. Goldman Sachs and consensus estimates 2025 looking at the lower end of the 4 range. Same with India, Brazil, and Russia. Growth looking robust across all of these economies, and we can see that advanced economies in 2024, the consensus is 1.5% growth, emerging markets 4%, and globally we're looking at a 2.5% growth in 2024 and 2.6% in 2025. So this is why you want to stay long equities, because growth is looking rather strong. Guys, 2 to 3% is what you really want in growth in this region. Very, very healthy. And that's actually what we're seeing in the US for both 2024 and 2025. And as long as the labor market remains robust and the normalization we're seeing doesn't turn into a deeper correction in labor market trends, the consumer should remain healthy and growth should remain healthy. That's good for stocks, especially with rate cuts.